listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Hello, Jim.
Well, an interesting past week where we saw gold plummet like a brick, and now the analysis taking a look back. What's happened, David? I think we're in brand new territory that we've never seen before.
I agree, and I would call this little talk today metal cuts paper. The gold and silver disconnect has arrived, and I believe that's exactly where we're headed. I think it's a new paradigm shift, and a paradigm is a new way of looking at and doing things, totally different eventually from what took place before. And when you have a new paradigm, the rules change. What worked with the old paradigm doesn't work with the new one, and also all of us end up at the same place when that changes. We need to figure out what the new rules are and then apply them. So each of us is at the starting line in the same place at this point. And I don't know how this is going to look going forward, but I do know that we're not going to ever see quite the way we saw again where the paper price rules the physical. Because the response to this big takedown that you mentioned in gold and silver was completely the opposite of what you would expect. Nobody is selling in the physical market. They're trying to buy. And this is all over the world. This isn't just one country or one asset group. It's people standing up, and many of them who probably have never owned the metals before, and they're mobbing these places to buy. And it's not like there's not metal out there, because there is. It's just not in the form that people need to buy right now. For example, there are 1,000-ounce bars of silver available, but people want to buy the 1, 10, 20, and 100 ounces. And so that's creating bottlenecks in the producers. But the point is we have a sustained demand for gold and silver, and I suspect platinum and palladium under the radar as well, too, because more and more people are coming to understand and see this as money, which is what it's been for thousands of years. That's what gold and silver have been, is money, and they're getting rid of the paper currency for money. So this new paradigm is what's going to drive things forward, and more you're going to see that the price of gold is different than the gold price, as one analyst mentioned. The price of gold is what you pay to buy an ounce of it physically. The gold price is what the paper traders say it is, and that's becoming more and more distended, and eventually I believe it'll become a rupture.
So what you're saying is that the price that we're seeing right now on the trading board is not really, you're going to have to pay more than that to buy that ounce of gold?
Much more. And right now the premiums are very, very high, whether it's junk silver or whether it's the trade rounds or any particular size, and same with the gold premium in certain respects. The point being, I think if people really get the idea, which they are, that the metals are money and look at it in that regard, then they will approach it in a different way, and they'll pay less and less attention to the paper price, because what good is it if silver is supposedly at $23 and the paper price today, but you're going to pay $30 to buy it? And people are finally seeing what most of them didn't realize in 2008, and this is becoming even more pronounced. So I think if we, as all of us as listeners and as participants in these markets, start viewing things in a different way and say, okay, there's a new paradigm that's upon us. What are the rules that we need to follow in order to be successful? And if we approach it with new eyes, I think we'll see new and very beneficial results, because we have not seen the last of high prices for gold and silver.
I think what people are doing is hedging against inflation, because we have so many countries, the U.S., Japan notably, printing money faster than you can blink. And when you do that, of course, that means that particular dollar or yen in the long run is worth less than it was when you printed it.
Yes, think about the Japanese, how much purchasing power they've lost. Now, right now, a case can be made that we're in a deflationary environment in many areas of the world because of business slowdowns and things like this. But the reality is, with all the money printing, whether it's digitalized or actual physical money, there's more money sloshing around out there at historically low rates. And at some point in the future, and it's already starting, we're seeing this in certain sectors, inflation is going to take hold, and that eats away at the purchasing power. And as more and more people understand how debilitating that is to what they actually have to spend, they're going to see that they need precious metals as part of their portfolio and eventually as part of what the money in their pocket is that they will at some point spend.
And of course, experienced money people, financial planners and so on have always been saying, well, at least the ones I talk to, have been saying for the past year, you should make sure that you have precious metals in your portfolio and don't panic when you see big jumps or drops in the price, because that's not really what's happening with it. It takes, 30 days to have a gold order go through. So if you short it, you've saved yourself a lot of money.
Well, that's true too, but here's also another thing is I think is the scales are falling from people's eyes. You have the liquidity when you have the precious metals to spend some of that if you need to. If the banking system freezes up, if a bank goes under, if there's a bank run or whatever, you have metal. That's a whole different situation. If you have it in your hand, they can't lock the account and say you can't transfer it out. You can only take out $100 a day. Look what's going on in Argentina. Look what's going on in other countries, and what happened in Cyprus, where you wake up and suddenly there's a new set of rules, usually on a Sunday night. And so having that metal that you have access to gives you a whole range of possibilities. You can sell it anywhere in the world. It gives you a whole range of possibilities that you do not have with the increasingly tenuous state of affairs with paper currency.
Taking a look at some new developments, a big land rush underway in northwestern Saskatchewan, the Athabasca region. Apparently more high-grade uranium has been discovered there, and mining companies are running over each other trying to snap up property there now.
This always happens when you have some type of a new discovery or potential discovery. And regarding getting back to gold and silver, one of the things that people have assumed for quite a while, and in the Morgan Report, we were in the third month of our study on this. We're doing a 4-part study about the supply projections for silver for the next 10 years. They've assumed that a number of these projects are actually going to come online. Some of them will, but some of them won't, and one of the very biggest ones is the Pascua-Lama project. It's really questionable right now that Barrick is working on the Chile-Argentinian border. This was going to be a monster. It was going to produce 35 million ounces of silver per year and 800,000 ounces of gold. Now, that project may at some point come to fruition, but it's becoming more and more questionable, and there's even rumors out that due to environmental opposition that Barrick may have to abandon that, and they've already put about $4 billion into it. So this is a huge, huge deal, and this is just the most visible of several other large projects that either were supposed to come online in the next couple of years and may not for years thereafter, or maybe not at all, and that sort of thing is going to impact the supply, what people see that was likely to be the supply for the metals, and that with increased demand is going to make this disconnect between the paper and the physical even wider. And as David Morgan has stated for many years, it's demand that drives price, not supply. And if demand continues the way it has and is sustained globally, you're going to find at some point in the reasonably near future that the demand is going to so far outstrip the available supply that the price is going to become really, really difficult to project, and the premiums are going to continue to go through the roof in relationship to what the actual paper quoted price is.
People are going to have to stop watching that computer-generated figure that they see on their business television sets or their computer and start doing some actual research as to what the real cost is going to be to buy that ounce of precious metal.
Looking at the paper price and then going out and trying to buy the physical is going to be like watching a war movie and then going out and thinking that you can fight in the real war. And if you believe that, you're probably not going to last very long on the real battlefield.
John Wayne even got killed in the movies.
That's true.
Just remember that. If you think you can go out there ill-prepared and do a good job. What should people do now? Is it a case of try to buy as much as you can now, or, are you still going to be cautious? Could there be another big drop?
My feeling is that the person would want to consider buying in layers, just like we talked about buying in tranches with the mining stocks, which are still trying to find the bottom. And right now the premiums are pretty high, and depending upon where you are. But if you have no metal, you probably want to get some, but you want to buy it over a period of months, because there's a real possibility that we will see lower prices for gold and silver before they end up going and breaking out from the range that they held just a few weeks ago. It'll be a broad trading range. And so we have silver today at 23, and gold at 14 something. Those prices are subject to further weakness. So if you don't, instead of going all in today and paying higher premiums and paying higher prices, if you buy over 4 or 5 months, let's say, I think you'll find an average price that's closer to what you feel comfortable with. That would be what I would do if somebody was looking over my shoulder, that rather than giving professional advice.
And I could see too how long-term supplies could be hurt because the junior caps have had so much trouble trying to raise money. They're not set to go to start digging up more gold and silver because they don't have the capital to do it.
And this continues to be the case, and as you know, the new exploration discovery by the little juniors, by the little exploration companies, are what feeds the pipeline of even the intermediate producers, let alone the large ones, because they, by definition, their deposits are a wasting asset. For every ounce they dig out of the ground, that's 1 ounce they have less that they can dig, and they need to replace that over time. And so with the slaughter that's taken place, and it continues in the exploration sector, you're going to find much, much less exploration money going in to look for new discoveries, and that is going to have a very deleterious effect over the coming years on the actual supply that's available, not to mention what's going on with these big projects that have already been discovered but have political and social overtones that make some of them questionable if or when they will ever be developed.
Once we know where these companies are going to go, is that going to make a big difference in the price, or is it inevitable we'll just have such a big demand that we can't fill all the orders?
Over time, you just have to watch the particular company, get to know them, and it's as important as it ever was to do your research and come up with those few companies that you feel will be last men standing. And they're all not going to go away. There's going to be survivors. And you figure out which those are, the royalty companies, the juniors that have good projects and have cash in the bank and are in, reasonably politically stable areas. And I think if you concentrate on those, you're going to be very happy over the next few years.
And I saw a good piece of advice. Somebody said, well, if you do your research, go on the internet and take a look at their websites. You can find out if they're going to be a good investment or not. And this very experienced portfolio manager said, well, before we got hung up on the internet, people used to come in person to my office and make presentations. And he says, not once in 25 years did they ever say, gosh, we're falling apart. Don't invest in us, even if they were falling apart. So sometimes you have to dig a little deeper than just taking a look at a web page.
You have to bring a practice eye. You have to be skeptical. Go to the website, talk to the IRs, go to the conferences. That's where you meet these people in the flesh. And those conferences are going on. There's one coming up May 27th and 28th in Vancouver, a big one at the Cambridge House. Go there. David Morgan will be speaking there, among other speakers. Go and meet these people in the trenches and talk to them and make your own you get your own opinions based upon the interaction you have with them. This is a great opportunity to go to these conferences and meet them firsthand. In addition to learning what you can by talking to people on the phone and going to the websites. It's all good procedure.
Thank you very much, David. Interesting times.
You bet.
My guest has been David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HoweStreet.com radio. Find us on Twitter at TalkDigitalNet. You can contact us at info@HoweStreet.com. I'm Jim Goddard.